This session is called Sustainable Lending and Transparency, and I'm very pleased to have been asked to chair this session. I'm head of the International Economic Development Group here at ODI. And so earlier on today, we had a discussion around debt dynamics and thinking a bit about sort of the African side of the debt equation. And this session will be on the other side, will be on the lender's side of the debt equation. And of course, it's not very easy to separate the two. It always takes two to tango. And actually, if you think about it in some languages, there isn't actually a distinction between borrowing and lending. So my native language, we all use one particular term for both of them. And so there must be intrinsically linked. However, having said that, I think we should think about those institutions that think about the lending side and are concerned about the lending side, perhaps because of their own business models, but also, of course, because they're concerned about how their funds are being used. I should perhaps also say that we've had a very good explanation already that debt is a very complex issue now in African countries, and it's both on the borrowing side but also on the lending side. So there will be there's a public side to this, there's a private side to this, both on the borrowing and the lending side. So there's public and private lending to the public and the private sector, which makes it very interesting and complex. And I suppose we should also be talking a little bit about the more structural lending issues and perhaps cyclical issues as well. So some debt crises are more cyclical and others are perhaps more structural. So we're interested to think about what lenders can do to avoid an unsustainable sort of debt build-up. And that for us is a very important topic. There are guidelines, voluntary guidelines by the OECD, by others and so on, that are thinking about this. So we want to hear a bit about those, how effective they are. We want to think a bit about how debt issues can be monitored, what metrics are the lenders using. And we want to be using, or we're thinking about what instruments lenders can be using to avoid debt pile-up in particular situations. And in order to discuss that, we have got a really fantastic panel. And I'm really pleased that we've got such a diversified panel. I would like to thank also particularly Annelise Brison and the organizers to put this panel together. But what we have is a wide range of actors. And just briefly to introduce them, so we have Giulia Pellegrini, who's Portfolio Manager and Director of Research for Frontier Markets at BlackRock. We then have Ruud Brouwer, who is the CEO at the TCX Fund, and I think that is it's spun out of FMO, the Dutch Development Organization, if I'm correct, and thinking about local currency solutions. We then have Jamie Drummond, who's the co-founder and executive director for global strategy for the One campaign, and of course he knows a lot about debt issues. He will no doubt explain, and has been deeply involved from the early start in the early 2000s and before on debt issues. We then have Janus Manuel Delis, if I pronounce it correctly, who fortunately has stepped in at last minute and he's part of an ad hoc committee on GDP-linked bonds, and we'll be talking about those issues. And finally, we have Judith Tyson, who is the lead researcher on international capital flows at Overseas Development Institute, discussing these particular issues. So we're really pleased to have this wide range of presenters. And we've given them 7 minutes to introduce the topic, and so we hope we can stick to those 7 minutes. So first up is Giulia Pellegrini, so we're very pleased to have you here, and particularly to give us sort of a private sector view on lending, and particularly about sort of the lending guidelines that exist. Do you think they are effective? Does the private sector use it? And you've also been working a lot around ESG issues, environmental, social and governance safeguards issues. Do you think that sustainable lending principles could be part of that? So over to you for a sort of a 7-minute introduction.
Thank you very much. So there seem to be at least a couple of questions in there. On the issue of guidelines on sustainable financing, I think they're definitely a step forward. They're a step in the right direction in that they prompt both lenders and borrowers to focus more critically on the issue of debt sustainability. Of course, critics out there will come up with things such as they're simply guidelines, they're principles, can they be enforced? They seem to look mainly at official bilateral creditors. So there's a number of things that could arguably be improved. I would say I'd rather approach the question from, again, the issue of how comprehensive they are, if they really map out the world out there as it is. What we have seen in the past decade has been an incredible change in terms of the way countries finance themselves, especially if you look at the poorer part of the emerging markets, at the least developed part of the EM, so the so-called frontier markets, as we use in jargon in the financial sector industry. So what you've seen is that in the last 10 years, you've gone from having about 38 constituents to JP Morgan's main EM debt index, the MB, where you capture US dollar denominated debt from emerging markets, to having at the end of this year 72. So you've nearly doubled the number of constituents into that important industry benchmark. Most of the new entries really come from, again, the so-called frontier markets. So the landscape out there has changed. It means that a broader set of countries, among them, there are some of the poorer ones in the world, are increasingly looking at the international capital markets for a reliable source of financing. So that has changed. What has also changed is that, especially in the years 2014, 2015, when you had a significant drop in commodity prices, you've seen a number of new ways of financing coming up. They're not so new. Some have been in existence for decades, but they sort of saw a resurgence. You've seen commodity-backed loans, you've seen private placements, you've seen a lot more bilateral, sort of commercial, rather, loans being taken up. So the type of instruments has changed as well, and it's increasingly difficult to capture them properly in that data for some of the poorer countries. Again, they may not have the capacity to do so. And then what you've seen is something that perhaps other speakers will address more later, but it's worth mentioning, the development of local debt markets. So local debt markets have seen a big surge, especially in the post-HIPIC world. That's in and of itself a very positive thing, I would say, because it obviously allows a country to have a very different source of financing in domestic currency from a domestic, perhaps institutional investor base that is growing. And that's all positive. I was very lucky to be given the opportunity as an ODI fellow to be working in the debt management office in Abuja, Nigeria, over a decade ago by now. And one thing that my boss back then, as we were coming out of Paris Club Debt Relief, used to tell me was that what we're looking to do here, we're looking to grow our domestic debt market. We want to really develop that, because the idea is that we no longer want to be owing money to our brothers or our cousins overseas. We want to be owing money to our wives. If you owe money to your wife, if you really get stretched and you can't make it, she's not going to go to the market square and embarrass you and say, oh, my husband's not paying me back. So what she'll do is she'll try and work something out with you. She'll be a bit more patient. You'll talk it out. Now, the problem is that over time, these countries have no longer been owing money to their wives. They're increasingly owing money again to their brothers and sisters overseas, including myself as an investor in BlackRock. So that part has also changed. It comes with the pros of local currency denominated debt, a local pension fund industry that is investing in your government bonds, but it also comes with increasingly foreign ownership that can get in and out of a country and generate some fluctuations that I'm sure we'll talk about. So the picture has changed dramatically. What I would say is that the guidelines have a lot of scope to improve capturing this broader picture. What I do like a lot is the fact that they place a lot of emphasis on knowledge accumulation and capacity development in these countries. They encourage a discussion around that sustainability. They encourage countries to really build the local capacity to be better placed to have those discussions with lenders in whatever shape or form they come, through the local debt market, through commodity-based lending and so on. At least you have the ability to have that discussion before you put that signature onto it. On ESG issues, I'll be brief. I would say that you definitely see a lot of attention being placed on transparency and sustainability these days. We are having a lot of queries, a lot of interest from our clients in helping them. They ask us to help them basically invest in emerging markets with a focus on sustainability, on ESG. So there's a lot of demand out there that's very positive. How do we do that? We've been doing a lot of work, for example, with JP Morgan in trying to rebalance their indices and no longer use simply essentially GDP measures and amount of issuance out of a country to determine this country's weighting to these benchmark indices, but also to include ESG considerations, so their performance in ESG terms in determining the weight that these countries will have in these indices in such a way that over time you can hope to encourage a virtuous cycle of international capital going to the better performing ESG countries from an ESG perspective rather than purely from an issuance or GDP size. That's work in progress. That work includes a lot of indicators that look at transparency issues. More can be done on the sustainability side, arguably. But what it also does is that, despite it maybe not being fully capturing these indices as they are, is to encourage investors when they do have these discussions with countries they invest in to ask those questions when they come in roadshows in London and you get the chance to meet the government delegation. You can ask, what are you doing from a fiscal perspective to make your debt more sustainable? What's your public financial management system like? How are you capturing your expenditures and your revenues in such a way that you can project your cash flow going forward and meet those debt repayments and so on? And so those considerations are not just part of the way that we as investors make decisions for our portfolios to meet the demands of our end clients, but also increasingly featuring conversations that before were purely, what's your fiscal deficit? How's your debt going to go? Yes, no, boom, done. So there's more of a discussion going on. And I think that in and of itself, although it'll take time, it's positive to see developing in the long run.
Okay, thank you. That's very helpful, Julia. So it's definitely more complex. More players are around, more different instruments are around. But also a positive message that you think about transparency within the ESG context, and that leads to helpful discussions going forward. So that's sort of a positive message there. You mentioned also about local debt markets, and no doubt the next speaker, Ruurt, will talk about this. So you've been working on local debt issues within TCX for a decade now, but can you tell us a bit more about your experience in local currency lending and whether that is helping to avoid a sustainable or to avoid a debt build-up?
I'd love to. Thank you. So it's always good if you look at sustainable, transparent lending that we take a couple of steps back, and I always like to start with what was once, let's say, the fundament of TCX, and it was a paper by Eigengreen, Hausman and Panizza called The Original Sin. And the original sin in financing actually referred to the fact that a lot of governments, but also companies, cannot get access to long-term debt abroad in their own currency. So the majority of the governments in Africa we're looking at today, they either do not borrow, hence do not invest in infrastructure, do not invest long term, or they're forced to borrow in the currency that is not their own. So by being forced in a currency that is not their own, they're effectively forced into currency speculation. That's normally not the primary business of a government. And it's interesting to look at it from the outside, because if we would look at any Western government, for example, being here in London, let's assume that the government of the United Kingdom would have 70% of its indebtedness in the Swiss franc. I mean, no rational thinking economist would allow for that. There is no way. It is hugely dangerous. It is pure speculation, and your government financing becomes a function of international financial volatility. It becomes purely a function of the volatility of currency markets. Yet, we think this is the way to finance African governments. Because ultimately, and that's an important one, even if you look back at the basis of our Bretton Woods institutions, the first loan ever made by the World Bank was to the government of France in US dollars. And that was not because the French government needed US dollars, that was because the balance sheet of the World Bank was in US dollars. So if you'd be looking today at the lending, be it from IDA, ODA, all of the OECD guidelines are based on dollar thinking. So one of the core issues we have in terms of sustainable and transparent lending is donor-centric thinking. We have dollar balance sheets, we have pound balance sheets, so we're definitely not willing to take the currency risk. We push it down to our clients. I mean, at the end of the day, beggars can't be choosers. So I think this is one of the key issues that should be addressed and actually is addressable. And even the IMF, we use IMF data to do research whether this is addressable, and it is as long as you have maximum diversification and you use local interest rates. So instead of offloading the currency risk to the recipient governments, you can, instead of doing a 30-year dollar loan to the government of Sierra Leone at 0.5%, also issue a 10 to 12% Sierra Leone debt. It allows the government to actually go into long-term financial planning, because they know for the next 30 years, yes, I'll be paying 12% on my Leone instead of the 0.5% on my dollar, but I can actually predict the cash flows needed. Today, actually, Sierra Leone is a fantastic example. In 1516, the Leone depreciated 50%. For the government, the Ministry of Finance, it means they need to double their tax income to pay back the same amount of debt. The vast majority is IDA, to pay back the same amount of aid. So whereas the original purpose of this IDA, ODA, OECD and all the other lending is to create economic growth, a significant side effect is actually that it causes economic instability. It forces the governments into short-term crisis mode, and, as we heard earlier this morning, it takes the energy away from capital investments, because short-term crisis needs short-term solutions, so we do not engage in capital expenditures. No, we postpone them. Hence, this is one of the key questions, I think, if we look at sustainable and transparent lending, to be addressed, because it is solvable. And there I'll briefly share some of the experience we've had as TCX. Currently, we have a long exposure on about 50 or 60 local currencies globally. We're partly financed by governments. The vast majority of our funding comes from the like of the multilateral and bilateral development banks. And our purpose in life is to allow them to lend to their private sector clients in local currency. Well, by having one, diversification, and two, using local base rates, we have generated 2% IRR, which is a pretty lame investment. But in terms of solving the currency risk issue, it's a relatively well-proven model, as we started in 2007. I think
Okay.
I'll leave it to that.
Thank you. That's very good. So countries shouldn't be having debt that is 70% denominated in foreign currency, because that's not a sensible strategy. So it needs to be more local currency, and you've been sort of successful in helping countries. I mean, I think it's a particular issue. So we looked a bit at the Ghanaian bond issuance a couple of years ago, and there if you thought about the local rates that rates that need to be paid were about 15 to 20%. On foreign bonds, international sovereign bonds, it was about 5 to 7% at that stage. But having devaluations of 10-15% a year would do away with quite a lot of the advantages in going to foreign currency, and sort of you're thinking about local currency. So having a local currency lending is perhaps a useful way forward, and I suppose we can be discussing that a bit more in detail. So that's been really helpful to think about a private perspective, perhaps also sort of a public-private perspective that TCX is. Let's now go to one campaign and Jamie Drummond. And so you've been in the discussing debt issues for a long, long time, and also are discussing a lot about transparency as well. And so perhaps we can take the two together. What is the role of transparency in helping to avoid the next unsustainable debt pile-up, and perhaps other issues that you'd like to bring to the table on this topic about sustainable and transparent lending.
Thanks, Derek, and thanks ODI for organising this. And apologies, I might have to spend 1 or 2 minutes just giving a bit of background, and then I'll go more to the direct subject here. So I have been working on this for a long time, as have others in the room, I know. But about 20 years ago, 80,000 people were organised by civil society groups from around the world to surround the G8 summit in Birmingham, and it led to one thing led to another. We ran a successful campaign that led to HIPC, the enhanced version, and MDRI, and then further and later on countries like Liberia. And I remember Antoinette talking with you 10 years ago, and one of my favourite quotes of all time was when we described it as an IMFing outrage that Liberia was excluded from the programme for a period. So it was great to see you then join the IMF after that. The great irony, the elephant in the room, is that we all were here having all of these exact conversations, apart from some of the new, admittedly, the new range of creditors in the room. But we were having so many of the same conversations 20 years ago. And the purpose of campaigning around the year 2000, as it was to evoke a unique amnesty moment, something by definition that only happens every 2,000 years. 1,000 years. But then if you go into the sub-details of the Leviticus paragraph from the Bible, it's actually every 49 years, and then the 50th year was the Jubilee year. And so you see, in fact, these debt crises are under the... And then, in fact, maybe half that, maybe a debt crisis every 25 years is acceptable. If it is indeed the case, and I think it is, that we're entering one at high risk of entering one now, that's every 10 to 12 years. So the nuclear half-life of crises is getting shorter and shorter. It's avoidable. But we are about to not avoid it. And why is that happening? And I think you touched a lot on it in some of the previous discussions, but Africa has a financing imperative, for sure. There's an extraordinary youth boom that demands an extraordinary financing package. The world and African leadership needs to put that together, and that requires brilliant borrowing and brilliant lending. Debt has got to be part of that package. But too many of these debts have been terribly directed, and unfortunately, in the context of very bad governance, frankly corrupt. And that's because they've been allowed to exist in contravention to the deals that were agreed, which were all about transparency and accountability. It was supposed to all occur under fair and transparent processes. And we did not campaign hard enough to enforce that be part of the ecosystem more deliberately at the time. And we trusted too many people in the international financial institutions and around the world to do their part to monitor the situation more closely. So here we are. There are some solutions, and they need to be enacted very quickly. Many of you already know what they are, but for example, the International Institute for Finance has put together these transparent lending covenant, and the exact wording has not been revealed to the world. It needs to be very quickly. Is anyone here from Credit Suisse, HSBC, Standard Chartered, Citi, any of the other institutions? Hello.
I'm not from many of those institutions, but I'm holding the pen on the principles.
Thank you.
And they will be revealed.
When?
I'm not sure yet. When those banks say we can, they will be. But in the next few weeks, they'll be shared with the G20.
This is a very important moment, and this is what campaigning is also about. Thank you. In my mind, the conference just did a very good thing. We need to work together to help those be the best they can be, get them agreed as quickly as possible by the G20 and elsewhere, because every single day is a possible new Mozambique debacle. Every single day they do not exist. Some other malfeasance could be taking place. And we do need a sense of urgency about it. These kinds of conversations are extraordinarily boring, as we all know. We are all fascinated by it, but most of the world is not. It is dry, it is technocratic, it is anti-democratic, therefore, because it is so dull. People don't find it very hard to be interested in these incredibly important issues we're discussing. And that's why the year 2000 was very helpful, because it forced a very boring process into feeling like it had to give birth and actually have a result. We need to create that sense of drama, to front load the sense of drama before the crisis occurs. And we need everyone in the room's help, and this conference's help and ideas, to dramatize the actions required to avoid this crisis actually occurring, because it is inexorably going in that direction right now. Over this short period of time, those principles revealed, worked on, and agreed by the private sector, and then the public sector creditors would be extremely important. Thank you. The other part of this is this information needs to live somewhere in an ecosystem that makes sense, that people can easily use. You know, the anti-corruption campaigners in Mozambique, the investigative journalists, are risking their lives trying to find this information out and hold people accountable. So it behooves us to make it as easy as possible for them to do their jobs by making this information as accessible and available as possible. So whether it be the IMF or some other institution, we need to ensure that there is someone providing that global public good, so that the intermediaries using information, as well as the markets, can access the information and make the right choices and hold the right people accountable. So there's a couple of things. It's about the guidelines. It's about some deadlines to force things to happen, because otherwise they won't. And the G20s and the spring meetings, and there'll be other moments. And it's about helping our colleagues on the front line get the information they need in good time. I'm sure we'll come back to some of this, so I'll finish there.
Okay, well, thank you, Jamie. So, a warning to us all. So we are need to be thinking about the next debt crisis. We perhaps walking into it, and it is avoidable, as you say. And so we need to listen to also, I think, what you're saying, and it's really important to think about transparency. We need to be more transparent, and probably will give you the word later on a bit to explain a little bit more on what exactly is you're thinking about. Very good. So let's go to the next speaker, which is thinking a bit more about sort of also cyclical debt. And you no doubt are going to tell us that it's not just cyclical issues, also structural issues. But it seems like a very good idea to think about GDP indexed bonds, so that basically you lend and you allow governments to pay back more when they're doing well, and you let them pay less when they're not when it's not going well in the country. So that seems to be like an issue, that we've been working on that for quite some time. Stephanie Griffith-Jones has been a research associate here at ODI working on these issues. So we'd like to hear from you a bit more about a renewed momentum behind this, and how this can perhaps help us to avoid sort of unsustainable debt pile-up in African countries.
Thank you very much for having me. Yeah, so I had some slides with graphs, but if they're not, it's not possible to mount them. That's. Oh,
is it this?
No, this is my telephone.
Oh, okay.
There you are. I don't know how you can. Oh, there you are. Anyhow, this is. I think this is. That's either a country in the grips of terrible debt, or what's going to happen to me if I overstep my 7 minutes. What I wanted to talk about was basically how can sovereigns deal with the challenge of rising debt, and in particular consider some contingent instruments. I'm going to focus more on GDP-linked bonds only because this is what I've worked on for the last 3 years with the team, the Bank of England, and market participants, one of whom is here, Salah Griffin. We tried to sort of regenerate the discussion that's been around by circulating a legal term sheet and to basically have the market and issuers tell us what they thought about it, or what it would be like to issue this. And the debate has been actually, I think, very useful, and it has, lots of very interesting things have come out. My last slide has a set of references for those who want to read more on that. But I'm also going to tell you a little bit more about other contingent instruments. So, I don't know what I'm doing there. I think, okay. Let me just put them all here. So there are basically 3 policy aims. The first is for these contingent instruments. The first is to increase the fiscal space of sovereign issuers in times of economic downturn. So that is very important because by doing so you avoid defaults, and defaults are always very costly because they just don't affect the sovereign, affect the whole economy. And also by bringing them in, you bring a better pricing for the fixed rate bonds, we think. The second thing is that they focus on the long-term potential of an economy. These are GDP-linked bonds, they're proper bonds, and they fluctuate both the principal and the interest, the coupon they pay, they fluctuate with the movements of the GDP. But they're meant to be long-term, 15, 20-year bonds, and therefore the investor really buys into, it's like buying a share in the country. It wants to prosper and support the country long-term. And so it aligns the interests of the sovereigns with long-term investing, and it forces the sovereign to focus on long-term economic policies. And we think that this is true for both domestic and international investors. Now, very important for the other topic that we're considering, namely transparency, is that this depends very much on accuracy and reliability of data. Both issuers and investors want reliability and soundness of data, and investors want to be able to compare. Now, we think that this is very important because it also helps the fixed rate bonds. If you're a fixed rate investor, by having more granular detail on what's happening in the economy, you can price better your fixed rate bond. So we think that this is also very important, and the IMF has guidelines for how you should be publishing GDP, and complying with that is in a way sends a signal to the markets about the way the country intends to deal with transparency. Now, this is. I have some slides. I'll go very quickly. This is simply shows you that if you have a fixed rate bond, you have a fixed cost because the debt service is constant, even forgetting the currencies now. But your income depends on your taxation, which depends basically on how well your economy is doing. So if you do not, if your economy is not doing very well, you can be in a default, as shown in the graph on the left. Whereas if you have something like GDP-linked bonds, well, your debt repayment, your service sort of goes down together with your income. So you avoid the default. That's the basic idea. Now, here, I'm not going to go into detail on this very much. This comes from a paper that the Bank of England has produced. On the left-hand side is developed economies, and on the right-hand side is developing economies. And it basically shows what the stress, the outer limits where you would be if you had a fixed rate or all your debt was fixed rate or GDP linked. It's all the same currency. It's all domestic currency in our model. And even on the assumption that the GDP-linked bond is basically 1% more, the coupon more than than your fixed rate bond. So I won't go much on this. It's just basically to show that you do the elevated debt stocks that we've seen in the world basically do require a solution. That's all the more so in Africa. With interest rates being also where they are, and inflation unlikely to be moving again. Certainly, the hard currencies very fast. So, what are the other things that one could have a look at? I mean, we've looked at with what we call the London term sheet. We looked at GDP, but other state-contingent debt instruments are possible, and variables such as commodity prices or COCOs, specific events occurring that disrupt the economy, that allow, say, for maturity extensions. So these are also possible. Now I want to say, to pick up one last thing that before I finish. Because there was a point, I think, in the last discussion where people just said, well, all this sort of investment, capital investment, increases GDP, but doesn't increase, immediately the revenues, and so they're still problematic to pay service debt. So it may be that GDP-linked bonds, for this reason, would not be appropriate for all African countries. However, it seems to me that still making small issues and servicing them and making the appropriate disclosures could still be a signal for how the country intends to manage its public finances. And on the side of it, depending on the economy of the country, we could use other state-contingent debt instruments based, for instance, on commodities. So thank you very much.
I mean, just one issue. Of course, it's tricky to get data on GDP and so on, and particularly in developing countries where you got revaluations of 50%, 60% in particular countries. But just in terms of these instruments, have they actually been used? So you've worked on Greece, for example. Would that have been would have worked there?
Yeah. These instruments, the ones that we are trying to propose, have not been used, and thank you that I should have made this clear. This is just simply a design. They have not been used. What we have used was what has been used is warrants, and warrants are usually issued in the context of a restructuring to offer an upside to the people who've suffered the haircut. But warrants are highly bespoke. What we have in mind with the GDP Index Bonds is to have something which is fairly standardized and almost, be a new and recognizable, instrument that will stand on its own. Yeah. We still do not have it, but we think that for the reasons I mentioned at the beginning, it would be, very, very useful because it would help with sustainability, and it will also help with transparency.
Good, thanks. So we've heard about GDP index bonds. What other financial innovations are there, Judith, to help us with to avoid an unsustainable debt pile-up?
I wanted to just spend the time here talking about policy and policy support, and particularly in the context of the rise of private finance, which I think we've seen discussed here, and particularly the fact that private finance is becoming much more predominant in both sovereign debt, but also, I don't think it's been particularly brought out, but if you look at the data, it's also in the corporate borrowing, corporate finance markets in developing countries as well. So we're seeing a significant expansion of private finance. And what it means for that to be sustainable. Now, some of those themes we've already hit on, but the criteria that I would put forward to describe sustainable private finance would be very broadly that it supports structural transformation, but in order to do that, it needs to be cheap, it needs to be long-term, and it needs to be stable. And stability here is ideally anti-cyclical, but certainly not pro-cyclical, and also low risk. I'll come a little bit more to what I mean by that in a moment. I think in the context of debt sustainability and private finance, and it's the riskiness of it, it's important though for us to understand that the majority of private finance remains in FDI. In fact, more than 50% of all international capital flows to sub-Saharan Africa in the last 10 years has been in FDI. And in many ways, that's an ideal form of finance. Of course, it's quite sticky. It tends to be low cost, and it often goes directly into private finance, which helps with economic growth. So, a little bit of moderation when we look at some of the debt ratios. FDI is, of course, a very important thing to support from policy, and we're seeing a lot of it still. But some of the new finance that we've been discussing in this conference is far from ideal. And I think Greg did a great job of describing the problems with it in the last session, which is it's expensive, it's pro-cyclical, and in particular it's highly risky because it's predominantly, in fact in many things like the Eurobonds, exclusively in hard currency. And so this is almost the opposite from the sort of finance that we would like to see. Now, I think if we take the assumption, though, that we need private finance, and I think there is a consensus around the need for private finance to meet the SDGs, we need to turn around the sort of finance that we are seeing mobilised to make it sustainable under those definitions. I'm going to suggest that there's probably two things that policy can do to help try to support that and be innovative. The first is that we need to broaden out the scope of the investors who are providing finance from international capital markets. And in particular, there's a need to mobilise finance from low risk and low return investors. And that really predominantly means institutional investors. The kind of flows that we've seen at the moment have been from much higher risk investors. They tend to be frontier market investors or private equity, and we shouldn't necessarily be negative about them in the sense that they were prepared to take the risk, but they are high cost, and many of those flows are also pro-cyclical. But for institutional investors to be mobilised, we need to deliver products to them that meet their needs. And these are investors who have high levels of fiduciary responsibilities towards often small investors in developed countries. You can see here, you can look at my paper if you'd like to read this a little bit more. The problems or the barriers are fairly, I think, established. Lack of bankable projects, political and FX risks and product design. But the most common response to this is simply not to invest. So we need to do a much better job of tackling these issues for them. Probably there's two things that we can do for policy. One is blended finance. Now, of course, blended finance has been discussed extensively probably in the last couple of years in policy circles. We've actually seen a rather low level of mobilisation of private finance. The ratio is about 70 cents for every dollar of public finance. To meet the SDGs, we need a ratio of $4. So we're probably at about 20% of what is needed. One success, I wanted to highlight a couple of success stories there around this. One has been around the creation of large funds, which are either syndicated or securitized products. This was one with MCCP, the IFC mobilized more than $5 billion, which obviously a pretty significant level of investment. IFC supported this obviously by structuring it, but also by being the first tier loss leaders. We would need to see many more of these type of funds. We are seeing them being discussed, but as I said, not many have actually triggered investment. So this is one area that we should focus on. We also need to see much greater facilitation of risk management. And this is risk management both for issuers, so for investors, but also for issuing countries and for developing countries. I won't go into this too much either because we've just seen a couple of great examples of innovation around this. TCX, particularly to tackle the problem with hard currency. I can't overemphasize the importance of this. Many of the countries we're seeing in debt distress have had their problems increase very significantly, not by just the level of debt that they're taken on, but by the revaluation of that debt relative to their local currencies. So I can mention Nigeria, Zambia, Ghana, all have had their currencies pummeled. It's originated in commodity risk, and it was interesting that you picked up that a variation on the GDP-linked bond could be around commodity markets. But their debt to GDP ratios have been hugely affected by the fact that they took on hard currency debt and it was impossible to hedge effectively. It's also an issue, a problem for investors because they are unable to effectively risk manage their risk preferences around hard currency debt. and their versus local currency debt. And so something like TCX, which allows them trade in and out of risk and adjust to their risk profiles, is also very important. Lastly, I'm going to suggest, though, that if this is to happen, we need to see a lot more focus around partnerships of particularly IFIs, but also elsewhere in other forms of policy around the needs of private investors. Now, I know some people might feel that that isn't the role of policy institutes, but I think it is essential that we are much more, we have products and policy that understands the needs of investors in order to induce investment, particularly, as I say, low cost, low risk investors. And that really takes a lot more flexibility. You can see some of the points I put up here that maybe you can, if you'd like to have a question, we can put through. But we need to see a shift in policy and much more innovation in policy if we are to see stable and sustainable private finance for development.
Okay, thank you. So we've had a range of presentations now on the lender's perspective, and quite a few issues came up, and so quite a number of issues that we can discuss. I mean, I draw out a few of them. One issue is around transparency and vis-à-vis the complexity that we're all talking about. So debt markets and the debt composition has become much more complex, and there are much more complex instruments now. There are many more players, yet we also demand more transparency. We need more transparency because otherwise we're sleepwalking into the next debt crisis. So that particular, that's a conundrum that we probably need to unpack a bit more. What do we think around this? Can we force more transparency? Is it working so far? What else can be done? Secondly, there are guidelines out there, and there are voluntary guidelines around ESG, for example, and some of those have been shown to be working. There are more discussions now that we all like to have or like to see happening. So BlackRock was discussing this. Are these discussions happening enough, and are they happening only in those markets that are maybe the predictable ones, and the ones that we really want to have a discussion, they're not taking place there? So that may be another discussion. And then we had a discussion on a range of different instruments with different purposes. So we had the TCX funds, for example, discussing about particular issues. We had GDP Index Bonds as a particular issue, and there are others as well that have pros and cons. And then you also mentioned securitization, syndication, and that might turn us perhaps even into other more complex lending instruments as well. But at the same time, they can help us along. So we probably want to discuss those as well. Now, before I ask the audience to think about questions, there is somebody who would like to give the word first. It's Thomas Fage. So you're here. You're from the European Commission, and perhaps you'd like to offer your first reflections on what you've just heard.
Yeah, thank you very much. I'm working at the European Commission in the budget support unit, responsible for public finance management and macroeconomics. And the European Commission is not a lender. All our aid is in grant. But we are, of course, very much also concerned by the debt situation. Because our preferred instrument is budget support. 38% of our aid is, of our bilateral aid country programs is through budget support. And macroeconomic stability, debt sustainability is one of the eligibility criteria. And secondly, also, we are providing, we have the European Investment Plan, and we are providing blending. The European Investment Plan foresees a new guarantee of a total of 1.5 billion euros to trigger additional investments in partner countries on concessional terms, to which we provide grants to European financing institutions, so to make project financing concessional. So this is, of course, important for us, and in this context, we are also the Commission is also collaborating within the G20 group, for example. My points are, I would first of all like to thank the panelists for the interesting contributions and perspectives. And my points are a bit related to one would be on the transparency agenda. How could we, what else would need to be done? How could we ensure compliance? For example, we were talking a lot about lacking data. We have to work on expanding that reporting, but on the other side, we also have quite a lot of data existing. Would it help for increasing transparency to build something like a central database that would be publicly available? What would the private sector think about that? What are limits between transparency and ensuring competition? And then on the issue of compliance, how could we build in, for example, checks and balances in that lenders are obliged to report, and at the same time borrowers are obliged to report in a way that would enable cross-checks about loans, a little bit like the model of the Extractive Industries Initiative, that would allow cross-checks where we could enhance reliability of data. That would be one line of thoughts. And what would you think could be the role also of the regulators on this transparency agenda? Then for the private sector, we had the issue this morning about the point about Mozambique, and what struck me in the Mozambique case is that the loans did not even pass by the parliament. So it's an accountability question here. How can we ensure that also the private sector, and I think there the guidelines, the voluntary guidelines for the private sector have to be sufficiently concrete, that the private sector also respects the regulations of the partner country in terms of accountability and loan approval, and insists on that as an additional check. And then finally, I have a question on the GDP indexed bonds. How do you deal with the issue of moral hazard in that in case where a country has a GDP indexed protection, that maybe the discipline in terms of macroeconomic stability and fiscal consolidation would deteriorate a bit?
So there's some very good points there already to start off with. I mean, although you don't give grants, you can work with lenders, and so we were working at some point on this fee-flex instrument, where you think about IMF working together with the Commission, for example, around these issues, and it was really appreciated by some of the ACP, the African, Caribbean, and Pacific states that was being done. So, but some pointers as well and questions really to the panel. So that's been really helpful. Now, I'd like to ask the audience if you have questions. Perhaps you can introduce yourself briefly and then make a point or a question. I will take about 3 or 4 and then go back to the panel. And I'll start on that side, so my left of the audience. So Mark, you were first.
Hi, my name is Mark Boland. I'm an Africa economist for Bloomberg Economics here in London. So my question is on these GDP-linked bonds. I believe there are some in place already. You know more about them, but I just want to ask primarily Yanis and Julia, what is the investor interest in this? I mean, it makes a lot of sense in many ways to have these instruments, but I personally get the impression that not a lot of investors are prepared to take on this risk or know how to price this risk. So I'm guessing you've been in touch with, discuss these matters with some of these investors and potential investors, and I'd just like to hear your view on that. Thank you.
Good. That's a good question. Is there anybody else who'd like to ask a question? So there are 2 points already on GDP index bonds. If there's nobody on that side, then I'll probably go perhaps on behind there, the lady at the back.
I'm Starla Griffin from Slaney Advisors, so I'm here supporting Giannis on the GDP-linked bond issue, but my question is actually slightly different. With respect to FDI investment, I agree that that's the best kind of investment for the African continent, but that creates risks as well in terms of debt when you have arbitration claims that grow out of some of that foreign direct investment. And you have African sovereigns whose debt profiles increase dramatically when there are arbitration judgments issued against them. And I have not seen much in terms of fora discussing debt that is looking at debt financing on the one hand from the market, and then debt, sovereign debt that develops as a result of arbitration judgments. And I think that that needs to be a discussion that is comes together in some fora. I don't know about if it's today, because I'm not sure that the attorneys general in the African countries are talking to the debt management offices. I'm not sure that the creditors who are buying the bonds are aware necessarily of the liabilities that might be existing. I'm not sure that the disclosure that you see in some of the bond documentation is taking account some of these liabilities. And I'm not even sure how the IMF is dealing with these, if they're still considered contingent liabilities, even when judgments are rendered. And I think there are a lot of issues that are surrounding these FDI-prompted arbitrations. So that's just something I wanted to raise as an additional issue.
Yeah. Okay,
later.
thank you. Gentleman here.
Hi, I'm Shao from China. I just wish to know, for the African context, infrastructure needs is sometimes very hard to meet because of the loans can last many decades, and the returns might not be so appealing. So I don't know, from your perspective, how to encourage the lenders to invest more on infrastructure, but without incurring huge debt for the local governments.
Yeah, I mean, that's a very good point as well around, so some infrastructure pieces are really profitable, and we think about telecommunications, but others, perhaps railways, might not get a huge sort of financial rate of return. Perhaps economic rate of return might be much higher there, and so then that might be a particular issue. So the final question here, and then we'll go back to the panel to answer the questions.
Okay, Abikadir from Sheffield University here, senior lecturer in international business. My question is to Judy's on TCX, the success stories that you mentioned. But evidence so far shows that in local currency bonds, there is limited foreign participation. So are we very happy to hear if you have any suggestions what countries can do? I think this is at the heart of even the first question, which is really linked with GDP indexed bonds, but local currency bonds.
Thank you. So we'll come back to you in a minute. Let's first go to the panel. So there are a range of questions around transparency and data. So database and what can regulators do? So something about transparency there. There are questions around the private sector interest in GDP index bonds, and some other issues around moral hazard, GDP index bonds. So and then some specific questions also to Judith as well. So maybe let's go first to Julia and Yannis about GDP index bonds, the question there, and the private sector interest in this.
Sure. So what I would say is that, so Yanis was explaining that these are, they've worked a lot on these new instruments and they haven't yet literally been used, in the sense that we've, as a private sector, been exposed to GDP and oil warrants in cases of debt restructuring, but this new set of GDP-linked instruments is yet to be actually tested. To the extent that there can be a market out there that can be formed around these instruments, I'm pretty sure the private sector average investor will be interested in having a go at this and investing in this. Quite obviously, as you noted, there's an issue of pricing. That's really how you form a market. How do you price these instruments? And for that, essentially, you have two problems. You have the issue of data availability and reliability that we sort of touched on before, and that cannot be overemphasized. If you have a GDP-linked instrument, you need to know that you are relying on reliable GDP data that comes out of countries you may not know very well firsthand, that may be experiencing all sorts of data issues in and of themselves. So that complicates the matter. And the second thing is liquidity. At the start, any of these instruments will most likely be rather illiquid single issues, which will make it difficult for any private sector player to really price this and create a market around it. So to that extent, any sort of program around international financial institutions supporting this with a more fully fledged program that supports these new instruments could be a way to create a market. I'm thinking also of a slightly different instrument, but something that was touched on before, Ghana Eurobond a few years back, a couple of years ago, that benefited from a partial guarantee from international finance institutions, one in particular, that was kind of shot down as a not particularly successful issuance out there. I think it's partly because there was no way to price that appropriately in the market. It was one of a kind. If there is instead a program of a number of these countries, and the IFI backing this comes forward with a well-marketed, well-presented program that explains how this is going to work, that is going to touch a number of countries, that is going to develop in this way in so many years, and hence creates a liquid market, I am pretty sure that private sector investors will get involved in that, because they'll be able to price those instruments and present them to their end investors accordingly. At the end of the day, most of us run funds that have daily liquidity requirements, in which anything like the large post office of a G8 country, as well as retail investors in another emerging markets through one of our local distributors are invested in. These people can come up to me any day and redeem their investments. I need to be able to provide that liquidity. So to that extent, that liquidity needs to be available for anybody to get involved from a private sector perspective.
So you would like to see a pilot that can show the way, that it can work?
Rather than a single pilot, a program. So instead of a Ghana-backed issuance, a number of countries with this program and a plan for several issues going forward.
Okay, very good. And on the while we have you here, on the point of the database that the European Commission was suggesting as a particular public good that might be able to help with this issue.
Yes, I mean it's a very positive idea. The issue is always the same one. It's data availability and reliability, and the reporting more often than not really falls on the debtor country. So to that extent, how to encourage reporting and, again, reliable information being given is something that I'm not sure how we're grappling with. The case of Mozambique is a case in point. It's a country that is being often discussed because it was under an IMF program, presumably also mandated to report some of these debt initiatives to their very lenders. This didn't come through. Leaving aside the private sector play into this, and how you noted, how did these gentlemen from investment banks sign on to deals without parliamentary approval? Well, that's something to ask their risk management departments, because in-house I'm pretty sure somebody should have asked some questions. So it's a complex issue, but at the end of the day we're going back to individual responsibility, be it a country, a sovereign, or private sector lenders. And so to the extent that that can be enforced or encouraged, it's a thin line.
Okay. Yanis, on this question around moral hazard and GDP Index Bonds, how would you deal with moral hazard?
Right. Well, Let's data is obviously very important, and we need to. The investor needs to know that the data are reliable, and there's always a temptation that if things don't start going so well, that somehow the data will stop coming. Now, in the proposal that we've done, we have an option, and it's just an option, of allowing, if data cease coming, or if they cease to comply with the IMF standards for dissemination, and the IMF keeps a record of who complies with the standards, then after a certain time, investors in this particular instrument would have the right to basically call the bond, just put the bond back and ask for early payment on the basis of even an uplift on the previously reported GDP. So the way we have proposed a solution to deal with this, we hope that if it ever comes to issues of this sort, there will be sufficient confidence so that this will not happen. People will not need to put this particular provision. But that's how we deal with it. Maybe other solutions as well. Now, if I may also respond to investor interest, and it's a great question. I think it was very well answered. Thank you very much. We have, and a number of us have spoken with investors around, and indeed the concerns are the ones you've heard. There's also a problem from the issuer side. Because investors will, if you offer something which has these features, and in particular you solve the liquidity problem, but the reliability of information obviously is very important, you'll find investors who are interested in the product. It is issuers who normally are reluctant so far, yet. Why? Because the expectation is that they will pay a higher price than in fixed rate bonds. And there's also, they're afraid, and especially I think if they first start with Africa, it would be different if, say, Canada would be the first issuer. But because nobody will say, well, what are they doing? What's the novelty premium for Canada? But if an African country does it, which especially if they don't have a good history for transparency, there will be a fear that they will pay an initial big premium. And the problem is always, even for Canada, that debt management agencies usually have a very narrow mandate of the cheapest possible financing. And the first time you're going to go out in the markets, you're probably going to pay more. It's going to look as if you pay more than fixed rate bonds, which are of course a different instrument. So there is a problem also to overcome on the supply side.
Okay, thank you. I mean, you mentioned data availability quite a number of times, and so multiple regulators, and perhaps Jamie also wants to come into this particular point. So certainly given your remarks early on that there wasn't enough transparency, so what are the steps that can be taken now to get a step change in transparency around the lending issue?
Well, so one of the things is a lot of information is available and not particularly well used, and then there's lots of information in these kinds of sub-components of the ecosystem that might be potentially transparent, but they're not going to the right cafes or pubs, or there's some sort of cultural problem where the communication is not occurring. And I say that, for example, it's recently come to our attention that the Mozambican, debt issue, the RFP went to, all the likely banks. They all knew about it. One of them went with it. But why didn't one of the other 19 that didn't go with it say to a mate at the IMF, "Did you know about this?" Why didn't that happen? What is the problem in the ecosystem that means that piece of communication did not occur? And if it's not going to occur because people just think it's probably a good thing to let people know, it has to be mandated and enforced in some way if people aren't going to be responsible in that kind of circumstance. So yes, we're going to have more and more of this. It'd be great if everyone behaved well. But yes, it's going to have to be mandated more and more. In terms of a public debt data registry, something like that will have to happen. Somewhere like the IMF will have to host it. No one at the IMF wants to because it's a lot of work, but someone's going to have to do that job on behalf of providing this global public good. And beware all the unintended consequences of that. I'm sure there'll be lots of things to figure out in terms of what sort of data's relevant there. the transparent lending covenant is a good start, and it's got to be encouraged along. It's obviously a voluntary process. Have no doubt that campaigners will be approaching places like the City of London to try and do something that's not voluntary. And so the quicker and the better the private sector works out things that work, the better the ultimate mandatory measures might be. That's what we found from other things that we've worked on, other areas of transparency we've worked on, not in the debt space, like in extractives. Yes, get ahead of this. Invest in it now. Don't slow it down. Put your best people on it, and be smart and move on it as quickly as possible. Get the right norms together.
Very helpful. Then on the question from the Chinese gentleman, around financing infrastructure, which might be useful for growth and transformation of an economy, but might not yield a lot of returns initially, and indeed you get a lot of capital for it and foreign currency capital. So what are the solutions there? How do you deal with that? Judith first and then Ruud, perhaps?
On infrastructure financing? Okay. Infrastructure financing, I think, it's quite a complex question, and there's a number of parts to it, but some of the slide hit on some of the points. There's a number of critical barriers. One, of course, is the lack of bankable projects. The average time to prepare, not to build, but simply to prepare a project is 6 years. Most private investors are not prepared to wait that long. The execution problems in developing countries are high. They're projects that are highly susceptible to political risk. We mentioned there that it's absolutely one of the critical problems that deters investment. And so I think there's probably a financing model which is about the preparation and execution of a project must remain with IFIs primarily, possibly through blended finance. But there is an opportunity to then syndicate it where projects are mature and operational. That's probably the short-term answer.
So now
Can I take a couple of other points, or you want to?
You want to make one more point?
Yeah, let me edit it because I want to hand over to Red on local currency bonds as well, particularly. On the transparency and sort of standards for private investors, I'm pretty cynical about it, and I'm cynical about it for a good reason and a bad reason. The good reason is we do need to understand that private investors are not accountable. Their accountability is not to developing countries. Their accountability is around their fiduciary responsibilities to investors and shareholders and to their regulators. And those constrain what they can do and they define their responsibilities, and we need to be very respectful of that. That's not to say that they are, within that context, they are not making investments to lose money or not to have it repaid, but that their accountability lies elsewhere, and we need to be cognizant of that in our dealings with them. I think there's also a bad reason, which is responsible investors will try to act responsibly, and with these kind of standards, they will try to adhere to them. But there are many who won't, and of course, it tends to. We've seen some examples of that, and it's very difficult to enforce it on a voluntary basis, I think. And so I think we need to look for the onus to remain with sovereigns, which is tricky in this environment, but they need to maintain primary responsibility around debt sustainability. On the local currency bonds, I think it's a really interesting question because the dream source of finance is, of course, local capital markets and local investment. There's structural barriers to the mobilisation of domestic investment, particularly around per capita income. You need surplus income to have domestic savings being mobilised in scale, and that tends to come with middle-income countries rather than low-income countries. But I think there are also things that we can do around stimulating local currency bonds, including the engagement of international investors. I mentioned hedging of hard currency risk. Maybe Roger would like to pick up on that theme because, of course, TCX is one of the primary providers of those type of hedges, particularly in low-income countries where there are no other providers. But we can also do things around benchmark issues. We've seen quite a number from a number of DFIs. IFC have been particularly active in this space recently, and of course around pricing transparency, which helps encourage liquidity and investment, including by predominantly high-risk investment, but also by some of the lower-risk investors as well.
Okay, thank you. And Ruud, isn't the answer local currency?
I think because what you said is absolutely correct, that there is limited international interest in local currency bonds. But interestingly enough, there is quite some interest in the market risk and return. So there are investors willing to invest in 5-year 12% Tanzania shilling. They just don't want to touch the credit risk that goes with it. Because the credit risk also involves KYC compliance. It's relatively small amounts, let alone for institutional investors. Just the thought they would have to switch off electricity in Rwanda because the government is not paying. I mean, the reputation risk that comes with it is huge. So they prefer to stay away from the credit risk and leave that to the MDBs and the DFIs because it's a specialized type of work. Now, interestingly, when we were running into, let's say, the limits of our capacity to grow based on our current capital, we were more and more actively seeking for ways to offload the currency risk. So we're sitting on this book of, I think, 25 African currencies. And actually, we learned there is quite a number of investors out there that are willing to diversify in AAA rated, but 5-year Tanzania shilling, Rwandan franc, even franc CFA, they're willing to invest in those currencies. And actually by creating this market, you simultaneously create an offshore yield curve and price transparency. This is a well-hidden secret. We started only 2.5 years ago. It's a relatively new market. But in the meantime, together with our AAA-rated investors, so specifically FMO, IFC, and the EBRD, by now we've issued over 50 local currency bonds all the way to Papua New Guinea, Kenya. So there is a market for local currency bonds. There's not a market for local credit risk. And I think by separating the two, we can make big steps forward.
Yeah, okay. Very good. I think we're perhaps a bit negative around the guidelines that are useful, but perhaps not. And I'd like also to discuss that. I would have thought that bondholders wouldn't like to see haircuts coming up. And I mean, Jamie was discussing the debt crisis happen every 10 to 15 years. If you think about Argentina, which has partially defaulted about 8 times in the last 100 years, if that's happening in African countries, I would have thought that there's a self-interest also for those lenders to be cautious about their approach. Let's take a final round of questions and then come back to the panel for a 1-minute reflection on this, because we have about 10 or 15 minutes to be discussing. So let's go first on this side. So the lady on the...
Hi. Hi, sorry, my name's Deborah Zanstra. So I'm a partner at Clifford Chance and I head the sovereign debt advisory practice. And I'm advising the Institute of International Finance on their sovereign debt transparency principles, which did start life off as Credit Suisse covenant, but has now morphed, I think, into a sort of broader initiative that will hopefully see the light of day by way of some principles. And I think to say just we've made good progress. There's a lot of support among banks to support the initiative. We have drafted some principles already. We have had discussions with IFIs, with G20, with a number of private sector participants beyond just commercial banks, and gathered views from people. And the IIF has set up an ad hoc working group to sort of take this work forward. One of the things is that the working group has asked that the IIF also reach out to sovereigns, because in the initial discussions they had not participated directly. So there is a consultation taking place at the moment where we've drafted a questionnaire, and this has been shared with a number of sovereigns, also with the help of the World Bank. And we're gathering their feedback, because the concern is that we don't want to face unintended consequences and find that this initiative in some way is too broad or drafted in such a way that it increases the cost of funding for sovereigns, which is certainly not the intention. What we're grappling with is the scope of countries that should be caught by this initiative. Should it be everyone or a smaller subset to begin with? Where should the information be held? And I think certainly the banks feel the IMF would be a natural home for that. But there are some discussions going on, and there are obviously liability issues and how to keep the information current and who takes responsibility for the submission of the data. And then the other thing is, what sort of products should it capture and how far should it extend? Is it just commercial banks? Is it commodity traders? Is it private sector participants that are buying privately placed bonds and so forth? And how can the IIF even bring some of these people on board if they're not members of the IIF? And we're also grappling with confidentiality issues within financing documents. We need to get the consent of the borrower or the obligor under that financing document for the banks to make that information available. We're looking at antitrust issues because there could be some antitrust issues in banks behaving in a group together in formulating this policy. And we're also looking at competition issues more broadly. We discussed the development of local markets. Well, if international banks adhere to these new standards, but domestic commercial banks don't, will that put the international banks at a disadvantage and therefore also have a negative impact on the availability of funding? But broadly speaking, I think everyone's really on board. The discussions with the G20 have focused more around how much these principles should acknowledge debt sustainability, and how much the private sector should agree that they will look at debt sustainability issues as determined by the IMF and World Bank in evaluating their credit decisions. And also some countries at the G20 level are quite keen on there being an acknowledgement as to actual debt ceilings recommended by some of the IFIs, and that's also something that's being discussed, but more difficult, I think, for commercial banks. So the direction of travel, I think, is good, but there's a bit of technical work being done, and I think it will see the light of day, but we must make sure we get it right, basically.
Some of the bilateral discussions we need to have that Simon was referring to earlier today, that's been really helpful for the update. There were a couple of other hands that were up, so I'd like to just make sure that they've got a chance. The lady at the back.
Hi, I'm Desno Marcy, Global Counsel. Just a very quick question from me, being a blockchain evangelist. Just the issues of data registry, settlements, finding things, having a ledger. Is nobody working on a blockchain of African debt? That's the question.
Yeah. So the gentleman here at the front, perhaps. Is it here, gentleman in the front? And then we go to the... Sorry for Elise. Sorry.
Hello. Thank you very much. My name is Godfrey Datima from Uganda, Commissioner Debt and Policy. Just wanted to have two clarifications. One on the defaulting country, that is, I think, Mozambique. I'm wondering why processes to do with the defaulting cannot be let take their own course through arbitration. Why the drama, why the demonstration, and so on? What message are we sending and to who? The other one on the recent successful innovations for private innovations. I just wanted to know where this has happened. In Uganda, we've had some private partnership infrastructure developments, of course, through foreign direct investment. This is to do with hydropower generations. It was successful in that it took off, it got implemented, but the rates proved too high. For that matter, we've been restructuring it with certain donor funding. So within that region, African region, where has it been successful? Thank you very much.
On the left, there were two hands up.
Gary Forster from Publish What You Fund. We're actually about to launch some work this week around multilateral and bilateral DFI transparency. Obviously, that's only a snapshot of the total investment and debt space, but it does give us an opportunity to develop a best practice around transparency in this space. what I wanted to know from the panel is where they would like to see the most sort of energy invested around transparency, because you could look at it in terms of the things that are being invested in, the actual activities, where those are happening, the sectors those are in, and the kind of information that's currently reported to the International Aid Transparency Initiative, the standard, which holds a registry of over $2 trillion of transactions and flows, and actually does cover debt flows as well, just for the room. You could start with looking at transparency around the mechanisms and the instruments themselves and how they're structured, the risks, the returns, etc. Or you could focus on the impact and the effectiveness of the actual things that are being invested in. So I just wanted to know from the panel where they would start if they were looking at that.
The final question here, gentleman at the front. Thank you.
Thank you. My question goes to Mr. Brower. The domestic debt of countries, I think, is also suffering from the original sin syndrome. The reason is that since 1996, when the HIPC initiative started, there has not been any threshold for sustainability of domestic debt. And even with the revised framework that the World Bank and the IMF came up with, which became effective July 1st, 2018, there is still no threshold for domestic debt sustainability. So, and of course, even when you look at the requirement for reporting of debt statistics, up to now, both in the IMF and the World Bank, the issue of domestic debt reporting, there is no comprehensive work where you can see any reliable figure for reporting domestic debt. So if you are promoting local currency debt now with no threshold for domestic debt, what is the fate of the bond in terms of reliability when there is no sustainable threshold? And finally, Juliana, also you talk about the roadshow that countries make before issuing bonds. I would like just to tell you that those roadshows, in many cases, are just political statements, not really reflecting the fundamentals of the economy. I think the best way to look at the risk associated with the economies is not to listen to the roadshows, but look at the fundamental numbers that are coming out of the economy. Thank you.
Okay. So final reflection of the panel. I give you 30 seconds each. You're allowed to answer questions, but as long as it's in 30 seconds. You may also just want to say one thing that we think we should take away from the questions or from the discussion. Could I start actually on the other side? Judith, could I start with you and then we come back here? So 30 seconds.
Okay. I'm going to reiterate that I think that raising or mobilising private finance is absolutely essential. That there aren't any other realistic sources of the scale that is needed to meet the SDGs, and we need to focus on policy that balances the risks and rewards of that for developing countries. I'll also reiterate specifically to your point that I do think that local currency markets are the nirvana. In relation to your question around should there be a threshold, maybe there should be a given threshold, but markets have their own threshold because part of the issuance of those bonds is around credit risk. And so that will be assessed. And I think there is reasonable pricing transparency within local markets, so on stock exchanges and within governments. It's not always captured when you look at some of the international levels, including, of course, corporate debt issuances, which, as I mentioned, has been quite significant.
Okay. Thank you. Janus.
First of all, on transparency, since we had a question, I think I would definitely go first with the data transparency, the primary data. Let people draw the conclusions about what the consequences are. People can always have healthy debates, but once we have reliable data, then we can have the policy debates about what's best, what investment is best. On the domestic debt, I want to say our proposal for GDP-linked bonds was to be in domestic. I agree that the market will find its own level of what's tolerable, but at least it allows the country to focus basically on its economy, because the domestic currency is basically its economy, and it won't have to do exactly to be a currency speculator, as we mentioned earlier. So yes, Of course there will always be problems, but there are a lot better problems.
Look, transparency is no silver bullet. You need a whole ecosystem, and you need values and norms as well as things that are enforced. And we need all of those put in place. In terms of your question over there, I'd like to know what you think the answer is. It should all be discoverable. In terms of where you start, it probably is with what would have stopped the Mozambican loan from occurring. Possibly that's one set of questions. And I'm really struck also that what Antoinette said earlier, that one investment that's needed in the ecosystem that people take for granted is that legislatures, you need the checks and balances within a country. And yes, you need it to think tanks. Yes, you need it to civil society. Yes, you need it to journalists. But particularly the legislatures need to be able to have a certain degree of oversight. And if they're given it a name, but they don't actually have the capacity, that's a real problem.
So first, hopping on the same question, I think ultimately you should fully understand the complete chain. So the source of the financing all the way down on the ground to the ultimate asset project, whatever that will be generating the cash to repay that financing. And only if you understand the full chain, you know that you're doing the right thing. And if the balance between the two is negative, then that should not be invested in. It should be financed by means of grants. Secondly, in terms of, let's say, your local markets, I think ultimately the solution should be in developing the local capital markets with local pension funds, etc., with transparency that comes with it. And I think there too, in terms of when you have your negotiations with IMF or IDA or whomever, it's also your turn to get rid maybe of the, the orphan way of thinking, and just push back and say, guys, stop pushing your dollars to us. We don't earn dollars. We earn cedis or whatever. That's what we need. And I would love to help you.
Julia.
Well, I'm very lucky in that most of the wrapping up points have been made by my fellow panelists, so I don't have much to wrap up on. So I use the opportunity to get back to Baba Musa's question on roadshows and local development, local markets development. On roadshows, it's really just a dance where countries get the opportunity to put the best picture forward and tell us about their plans. And then we get to ask questions about those plans. But it's our responsibility, and I can tell you most of my peers in the industry will do that, to then ask those questions and travel to those countries to find out if the picture being represented is actually truthful or not. And it is the responsibility of the borrower to give us truthful information, and it goes back to the data issue. So in a sense, we both give each other a chance, but then we check on each other's information. And that is why when we do our analysis, when we decide whether to invest in a country or not, if we see that we have a number of countries where more developed local debt markets that hence give us a bit of confidence if we invest in the dollar side, in the dollar-denominated debt, because they have this ability to tap into funds locally as well, so they have a more diversified debt picture. We also look into how much of their public revenues go into servicing those local debts. And as you know very well, a number of West African countries, for example, without naming names, are now facing the fact of a third to 40% of their public revenues going straight into servicing domestic bond repayments, which is a pretty important issue that we're monitoring because it will generate issues in the longer term. So that's just to give you a sense of the thinking that goes on behind investment.
Yeah. I think it would be quite useful to know where the receipts of the bonds are actually going to and what they're being used for, and if they're raised for a particular purpose, that they are actually used for that purpose as well. Good. We've jointly thought about a range of solutions. I hope it meets Simon's test. We thought about structured pilots of GDP Index Bonds. We thought about transparency. So think about a database, what the Commission was suggesting, but it's set in a wider ecosystem of transparency. We discussed guidelines and to be giving them a chance, rolling them out, the G20 guidelines. We discussed much more about local currency lending and local debt markets, developing those. So these are sort of 4 or 5 issues that we've come up with. I thought that has been fantastic. discussion around this issue. And tomorrow morning we'll discuss on the other side of the coin, the borrower and innovations there. All I need to do now is two things. So first to say that Raja Khan is going to be here in about 10 minutes to be giving the keynote for this conference at the evening. And so we can all go outside for a few minutes just to relax and then come back. But the final thing is that I'd like to think, of course, the panel session, the organizers, so Annalisa and Shakira, but first and foremost, those who presented here. So a big applause for our panel. Thank you.